Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success today. Trusts versus companies, what investors need to know. Welcome Jeremy and Dom. Thanks for coming back.
Good to be here. Thanks for having me back.
Perfect. So let's jump straight in. Trusts versus companies. Where did we want to get started with this one?
So I think we'll start with the companies first. It's probably a simpler vehicle to understand.
Sure.
So if you can bring up the slideshow.
We've got the slideshow, so anyone can watch this on any of their devices, but we've got a company structure.
Yep. So investing in companies, you don't tend to see it a lot. Where you do see it, there's a very specific purpose behind it. And most accountants and people will poo-poo the idea because they straight away go, oh, well, companies don't get the CGT discount. And straight away they say that's the reason why you would never do this.
Well, that's what I would think. Just don't bother.
Just straight up, no. There's the bit with the explosion of people trying to get borrowing and the unlimited borrowing power. Companies have made a bit of a resurrection. And I think it's also important to understand it does open up a lot of extra conversation around dividends and franking credits and imputation credits, which is quite heavy, but we won't cover that in too much detail. But companies are quite powerful at deferring tax. So with an individual, when you sell, you've sold, you'll pay a lump of tax and then your marginal tax rate will apply and then that's it, the tax is over. With a company, what a lot of people don't necessarily realise is that the tax that they pay can be accessed later as dividends and franking credits, and you can actually control the outflow of that. So you can space out a capital gain and actually claw a lot of that back through the franking credit system. So that's why companies tend to make a bit of a resurrection when people plan out something.
I would think, so it'd be beneficial, I guess, let's say you've got a company, it's done really well, you've got all these profits within the business, but if you distribute all that income out right away, like let's say pay each of the directors or like the owners, let's say $300,000-$400,000 a year, they're going to get taxed significantly because they start getting pushed up in the tax brackets.
Yep.
But if let's say I go work for someone as a buyer's agent or I'm a doctor, whatever it might be, and I'm earning a set wage, I can't defer that income to later years. But if you've got a business, you can. You're making the profit. We're not distributing it to ourselves, but we can push it back for later years. That's where the businesses can be really beneficial.
Yes. Yeah. And the other thing with companies is the positive gearing. So the negative gearing, everyone understands about negative gearing and getting the tax benefit in your own name. With companies, once it goes to positive gearing, companies actually become, it sounds crazy, but it's easier for a company to pay off a loan than for an individual to pay off a loan. And that's due to the individual tax rates. So if you think the money that you borrowed from the bank, you get a deduction for the interest, but to pay back the principal, it's from after-tax money. Now, if you're top tax bracket, you're paying close to 40, you're paying 47% tax on your income. The dollars you're sending towards the bank have to be after that. That's almost, so you're losing half. So whereas a company flat tax rate's 30%. So a company loses 30%, it's got 70% left to pay back the bank. An individual loses 47%, they've only got 52% of their income to pay back the bank. So a company's a good parking vehicle. That's why you tend to find companies will, once they kick off, they start to grow and they'll expand quicker because they can actually reduce loans faster than you could in your own name.
The tax rates within businesses, is it 25% for small businesses or 30% for?
Yeah, so the 25% tax rate for businesses, that's for what they call an active business. So a business that actually has active income, it's trading. So most trading businesses are 25%. Where you get the 30% companies, they're the super large companies, so your BHPs of the world. And also these companies, even small ones, if they're not trading, if they're passive investment vehicles. So if they don't have active income, they've got passive income, so rental, dividends, those sorts of things, then they're taxed at 30%.
Okay, that's odd.
Do you see a lot of investors set up these company structures?
There was a lot of old ones, and then there's been almost nothing for the last 10 years, and now some of them starting to come back. Yeah, because they are seen as a separate vehicle and they can go down that path of, well, I've maxed out my borrowing, let's set up one of these and we can do the next property in this one.
Yeah, so I guess with, again, I've talked to the broker about this, but like within a company structure, how's your borrowing capacity done within the business? Is it based on the revenue and the tax returns over time?
Yeah, straight up just the financials tax return of the business.
Okay.
Yeah.
All right. Perfect.
So with the company, so I just wanted to go through the actual legal steps behind setting up a company. So we're setting up the company XYZ Proprietary Limited, and what we need for this company is, next slide. So you have to determine, first of all, who are going to be the directors of this company. Now, the directors are not the owners. These are the people that just give instruction and direction to the company. So they're in charge of running the company, but they're not taking any profit out. Now, for directors, you can have a single director company, no problem with that, and you can have 2, 3, 4. You can have almost as many directors as you like. So, but you can start with just one. Basically, it's responsibility. Next slide. Then we're going to introduce shareholders. So now the shareholders, they're the people that actually own the company through their shares. So they're the people that if the company is profitable and makes a profit and pays out a dividend, it goes to the shareholders. The shareholders bear virtually no risk. So if the company is run badly and loses out and gets sued and has a shortfall, you can't normally go to the shareholders and say, well, hey, you've got a couple $1 million. We will sell that off and use it to pay off company debts. Their shareholders are virtually protected. The directors, depending what they do in that company, they can be held personally responsible, even down to ATO debts if they've done the wrong thing.
Okay.
Next. Now, let's say we've got our company, we've decided our directors and our shareholders, and they don't have to be, they can be the same people or can be totally separate. We've got our property, we've got our target acquired, and next step, company will go to get a bank loan. Next step. And then the property pays rent just to the company. Company pays the property expenses and pays off the bank and pays the bank loan, whether that's interest only or P&I. So it's actually quite a very simple type structure. It's separate from individuals. So it is a totally legally separate entity. And you've got the directors in charge of it and shareholders that own it. And then you determine, and that's basically a company setup. There's not much more to it.
I've heard of these things called bucket companies. People set these bucket companies up. So it must be like when a business has, I guess, retained earnings or profits at the end of the year, they pay tax on it and then they move money to these bucket companies. Can you explain what a bucket company is?
Yeah, so a bucket company is typically a non-trading entity, not even doesn't have direct investments like this. They're normally seen underneath a trust. So if you'd have a trust and then with a trust you have a distribution vehicle, it is a distribution vehicle. Typically, if you say, I've run out of people to distribute to or all the people I can distribute to are on too high tax rates, I'll park the rest of the profit into a bucket company and only pay 30% tax. So the key there being everyone around me is on 47% tax, I'll park it in a company and only pay 30. That's what a bucket company is about. It's normally the last line of resort.
Okay. Want to head over to trust structures now?
Over to trust. So now when you set up a trust, we have to understand companies first because a trust is also a separate legal entity. But for every trust, you need to have a trustee. Now you can go the cheap option and set up an individual trustee. So I'll be the trustee of it and set up a trust, and I've set up a separate legal entity. But most people, I hope 99%, and if they're doing their proper job, 100%, would say you should set up a corporate trustee in this day and age. So we are setting up a company first, and then we're wrapping a trust around it. Okay. Yeah. Now that company, the trustee company, comes with all the same rules as a normal company. So it's going to have to have directors and shareholders the same. And we've got the directors and the shareholders. Yep. So you've got the directors and shareholders of that company. They still exist, but that company is non-trading. It actually doesn't really have any assets in its own right. They're legally required to have shareholders and directors just because ASIC says that's how a company exists. Now, the next step, we have to have a document that describes the relationship between these two entities, and that's called the trust deed. So the trust deed is basically saying the trust is born, this company is set up in charge of this trust, is in charge of the trust assets. So the responsibility of running the trust falls onto the trustee. In this stage, it's a company, and the responsibility of running the trustee company is the directors. So the trust deed, so everyone talks about, your deed, your trust deed, that's actually a legal document, gets set up at the beginning of the trust, and it just explains the relationship, who the trustee is, what the trust is. Now that it also explains the beneficiaries, and this is where we're looking at a discretionary trust. Now, discretionary trust just means each year you get a choice. You determine what the profit of the trust is, and you say we're going to allocate that profit to the beneficiaries, and the beneficiaries are described in the trust deed. And typically, what you do is you'll set up a main beneficiary, so you'll identify a person, and then the trust deed says, right, this is the main beneficiary. And then you have the group of beneficiaries around it are all the people related to that person. So it could be the spouse, the kids, the grandparent, the parents, grandparents, kids, grandkids. It spreads quite quickly. So from that main beneficiary, it goes across and then goes up and down linear descendants as well. And so you get quite a wide spread of who can be a beneficiary of the trust. Okay, next one. So we've set up our trust, and then we go again target property, and that's our property we're going to get. And quite a simple stage here. So the property pays the rent into the trust, and the trust just looks after the expenses. Now, the difference here is that a trust doesn't actually pay any tax. It's like a big roundabout. It's a big distribution vehicle. So it'll say, well, I've made this much money, and then at the end of the year, it'll have to decide, who do I distribute the money to? I've got a profit of 10 grand. I need to allocate it to somebody within that pool of beneficiaries. And then normally that's where you look, who's on the lowest tax rate, and that's the person that will take most, if not all, of the distribution.
So in this scenario, for example, just speaking out loud, you've got a property, you've got the rent, but let's say it's negatively geared. So they would have to, who would inject the cash within the trust to make sure there's a buffer to absorb a negatively geared property within the trust? That
would typically be, well, anyone can inject capital. Doesn't have to come from the beneficiaries. Most of the time you see it is the beneficiaries, the same people, or someone related to the beneficiary. So you might have, mum and dad might set up a trust for the kids. So try and distribute to the kids, but mum and dad are the ones putting the capital in.
Okay, and where does that capital come from? Like equity releases, savings?
All of the above, and a trust can also borrow. So if you go to the next slide, there's nothing stopping a trust getting a bank loan. And this is where the trust will actually, and I've got two versions. Just stick on this slide at the moment. So the trust will get a bank loan directly, and it'll actually say, well, I'm going to borrow money just to buy a property. Now you'll have to put in normally the capital of the deposit and the stamp duty, that sort of stuff, unless you're putting up other security outside the trust, and the bank will lend 100% of the value to the trust.
So let's say you go buy a property for, let's say, $500,000, 500,000. So you need to fund the deposit. So you can come from cash, or you could take equity release, let's say from your owner occupied home. You take an equity release of, let's just say, 200,000 as an example, and that covers stamp duty, all your costs. Now, let's say I've done that. I've taken 200,000 equity release. Can I claim that 200,000 against those deductions within my personal name? So I've got this equity release in my own name, but I'm moving it to the trust. Can I go to the ATO and say, well, this is being used for investment purposes within a trust? Or they'll be like, you can't claim that.
Yeah, if you borrow money, there's a couple of ways to get it into the trust. If you contribute it to the trust, then there's no right to income in that situation. So really, you can't claim a deduction if there's no right to income. So you'll have a borrowing that you'll have to finance, and you've got which you can't actually claim. Okay, and I've got a scenario coming up of that. Now, if you borrowed the money and then on-lend it to the trust at commercial rates, well, then the deduction falls into the trust. So now the trust pays you back at the same rate that you're paying the bank. You're left in a neutral position, so you're actually not positive or negative, and you've pushed the deduction into the trust's books.
Okay.
So the trust has now borrowed directly from the bank the remainder, and what it's borrowed from you, it's paying interest to you, and you're offsetting your interest by what you borrowed from the bank.
Okay.
Now the next slide. Oh, sorry, can you just go back one more? Just important in this situation, if the trust is negative geared, and most of the time it will be negative geared at the beginning because of borrowing the 100% at some point, a trust has a loss. You cannot distribute a loss. So you cannot then say, I've made a negative gearing of $10,000 and push that onto individual people and someone saves tax. The trust actually has to quarantine that loss and carry it forward into future years. So you might end up building up losses for 5 years or so, and then as it starts to turn positive, the positive gearing will firstly offset the carry forward losses, and eventually once all those losses are absorbed, it'll then distribute a profit.
Can you have like another trust or a business setup where, let's say you've got 5,000 of losses within the trust for that year, but let's say you've got 100,000 of profit within the business. Can you redirect some of the business profits somehow to offset the trust losses in any way, or is that starting to get?
It's getting a bit grey. You have to give it a reason for it to allocate a profit across like that.
Yeah. Okay.
Yeah.
All right.
Now the last slide, what I've done there, I've just shifted the loan. So the loan, instead of being in with the trust directly, the loan is now sitting at the beneficiary level. So, or somebody else. And so that goes to your previous example. So if I go and borrow money from the bank and give it to the trust as a beneficiary, the problem with that situation is that a discretionary trust can change its mind year by year. So there's nothing to guarantee that I'm going to get a trust distribution, because it's not a fixed trust. I haven't bought a right to anything. I'm potentially going to get a distribution and potentially not. So it's not like buying shares in a company. You're a beneficiary of a discretionary trust. So the ATO will actually deny you that deduction. You can't claim a deduction for that bank loan in that situation. Even if you have received a distribution, the fact that it's not a fixed entitlement will say that you can't claim the interest on that loan. And that's a trap that I've seen a few people fall into. They've taken out a loan, put it into the trust and said, oh, hey, cool, I get a deduction and I've got no income coming in. And you say, no, you've sort of denied yourself a deduction here. The best we can do is call it an on-lend into the trust, and then at least the deduction is accumulated somewhere, falls into the trust books and gets carried forward as a carry forward loss.
Perfect. I think with these trusts, like when do they actually make sense? Because I see a lot of people where they overcomplicate it. Like at times I look at it going, okay, well, do they really need to set up all these trusts? Because one, what are the disadvantages? I guess expensive, time to set up, and then I think how the capital gains worked out. Is there a 50% discount within the trusts or not?
Yeah, so the trusts are the most expensive vehicle to set up because there's a company at the beginning of it. So you're setting up a company first, which has got no discounts, and then you've got to wrap a few $100 of legal fees around it for the deeds and trust deed and so. Then there's also stamp duty. So in New South Wales, the stamp duty is about $750 odd for stamp duty on a trust. So that's just for setting up a trust. Government tips their money in. I know Queensland, the stamp duty is nil. So we get people setting up Queensland trusts. And just because you set up a Queensland trust doesn't mean you have to buy in Queensland. You can use a Queensland trust to buy anywhere. But every state's got different rules on how much stamp duty they charge on the setup of trusts.
And there's no 50% discount, is there, within the trusts after 12 months?
Now, because trusts don't pay tax, that's not up to the trust to determine that. So the availability of the discount would then be based on who receives the capital gain. So if the capital gain goes from a trust to a person, then that person would get a 50% discount because the person will be entitled to a 50% discount. So it gets taxed at the individual level, at the beneficiary level. That's who ultimately pays the tax.
When does it make sense to set up a trust structure?
You normally see them after people have maxed out their own land tax thresholds is quite a common one, because if they say, well, I've already maxed out my own land tax threshold, so now I'll move into a trust vehicle because their serviceability starts to suffer a little bit. So they've already maxed themselves out. Set up another entity, the trust, say that it can service itself. You normally get a letter from the accountant to help with the application, because otherwise if you capped at your own serviceability. So if you say the trust can look after itself, then it opens up a whole avenue, another entity with an avenue of borrowing. Same with the company. If it can if it can self-service, then they allow it to borrow more. With the trust, you're going to pay land tax from word go. So that's why you generally see that after you've maxed out your own threshold.
I guess the amount of clients that you see, what do you think an average percentage would be, a proportion of investors would invest in their own name compared to a trust?
Oh, much higher proportion in their own name.
Yeah, and that's what I would normally see. So sometimes I get confused when I see all these trust setups, and one, the client doesn't understand the trust and why they've been set up. So do you think accountants will set these trusts up for business for themselves? Because I guess the annual the tax returns every year or more? Like, do you think there are accountants that set these up because it benefits their pocket more than the individual?
No, there's no accountants that do that. So. But I don't think so. A lot of the time people come in sort of bright-eyed and starry-eyed about, oh, well, I've heard about trusts. I think I need to get a trust. I've actually talked people out of trusts sometimes. So you say, well, okay, what do you need a trust for? And they lay out the situation. You just think you are the wrong situation totally for a trust. You're just going to lock up losses into this thing for probably 10, 15 years. And then you're going to be going, how am I going to service this when I don't even get the tax benefit out of it?
That's right. And I guess that's the advantage of going in your own name. Obviously, it's quicker and you get all those benefits early on while you're accumulating. So it's helping you from a cash flow perspective. Yep. And I guess the benefits of a trust later on would be how you distribute your income when it is positive or cash flow geared. So instead of paying tax at the highest rate, you can maybe move it to someone that's 18, 19, 20. It could be someone's kids, for example. Yes. And that's the way that they would do it.
Yeah, that's where they come into their own, because each year you get to decide who gets the distribution. The limitation with trust is that children under the age of 18 can only get $416 before they pay super rates of tax. So young kids are kind of pointless, or $416 of use per child. Where they work really well is once they hit 18, and then if they go to uni or if they have a part-time job, they're earning $25,000, and then you have profits in the trust that you can distribute to them, as opposed to distributing to yourself, and you might be on $130,000, $140,000 wicket.
Perfect.
Yeah.
All right. You want to go through the example? Is that what you had over here with our?
Yes. Yeah. So if we can go through the company just example. Now this is again the same table that we used for the individual episode, where we're looking at 2-year timeframes. And what I've done here, I've said we're going to buy a property, keep it for 10 years, and then sell at the end of 10 years, just to also look at how the CGT difference would apply. So similar example to last time, we've got 10% growth per 2 years, so it's 5% per year. The property we're buying is $500,000. Now we're borrowing 80%. Now in a company situation, we are negative geared because we're going interest only on that $400,000. Where the negative gearing annual cash is $9,000, -6, -4, and then $1,000, and then it starts to turn positive in year 8, and in year 10 it's more positive, and that's by virtue purely by the growth in the property value, which has driven the rental growth. So the expenses have gone up. So the loan interest hasn't gone up. The expenses have gone up just 1%. It's mainly the growing rent, which is attributed to the positive growth. But across the 10 years, you've had to put into this company $12,500, the sum of that coloured line there. So you've had to put that in. Obviously, you've had to put in $9,000, then $6,000, then $4,000, and you've put that money in, and then you started to drag it out. But overall, you've put in $12,500. We're then saying that you then sell in year 10, $805, and that's just from the figure up the top, which is growing 5%, $500,000, 5% per year for 10 years. The cash that gets released is $405 because you've sold at $805 and you've had to pay off the loan. So you get $400,000 of cash. Now you've made a capital gain. So this property that cost you the property that cost $500, you've now sold for $805. So you've actually, the company's made a gain of $305,000. There's no discount applied. So see that the discount there is zero. So the company will pay tax at company rates on the full $305. So the tax at 30%. So you're going to get a company tax bill of $90,000, $91,000. It's a big chunk. And then the after-tax cash, I said, right, so now with the money that it's been released after paying off the loan, so that's the 405. So if you just double click that to show the 313. Yeah, so the 405, the cash released after the loan payout minus the tax you've had to pay, you're left with $313,000. That's just at the sale point. Take into account the $12,000 that you've had to feed into it, this company's left you with $301. So you buy a property for $500, sell it for $805. It'll make $301,000 after tax in 10 years. That's what a company looks like. Now move across to the trust.
And the big advantage of that is maybe you might be, like, let's say you're maxed out in your personal name, but you've got a business that's doing really well. Do the lenders look at your personal debt if you're buying within the company or not? Or is that more of a mortgage broking question?
More of a mortgage broking one. But I can tell you that some of them, I know I've heard that there are banks that will just say, as long as the accountant says that this thing makes $1, then they will ignore looking outside.
Okay.
Now with the trust view, now it's a little bit more complicated and there's a lot more variables. We'll try and keep it simple because basically at the end of each year, the negative gearing at the beginning will just harm it. So from the beginning, all the variables are the same. Buying for 500, growing at 10% every 2 years, borrowing the 400, all the other variables are the same. Now, the net rent, there is no tax rate that applies. So the thing that hurts here is whatever the negative gearing is, someone will have to fund this thing by that full amount. There's no tax benefit associated with it. So and I've also introduced now land tax. Land tax is the killer here, 1.6% New South Wales. So regardless of everything else going on in your life, you're now receiving a $4,000 per year, $4,000 to $5,000 per year land tax bill just because you bought it in a trust. Is it negative geared? Yeah. Is it saving me tax? No. Is it costing me land tax? Yes.
It's a big chunk.
It's a massive chunk. It's a huge chunk. So somebody, and same thing, we're going to sell it after 10 years for the same price. But during those 10 years, you've had to feed this beast $92,000. And if you have a look, the majority of that will be, a good portion of that will be the land tax.
Yes, it really eats into your cash flows, doesn't it? Plus, you've got the impact of that money's locked up, so you're not getting any of the credits from the ATO.
That's right. There's no tax benefit associated. It can't distribute a loss. No one's getting a deduction. No one's getting a tax deduction for the actual losses being incurred here. Same scenario. So we're going to sell for $805. The cash released is the same $405. We just have to pay back the $400,000 loan from the bank. Capital gain is $305. We're going to apply those losses. Now, interestingly, so we have got carry forward losses of $92,000. They're seen as income losses. You can apply an income loss to a capital gain. Okay? You can't do the opposite. So if you have a capital loss in any vehicle, you can't apply a capital loss to income gains, but you can apply income losses to capital gains. So we're going to absorb the first $92,000 of losses there. So now we're left with $213,000. To keep it simple, we're going to assume we're allocating that to individuals that do get the discount. So $213,000 allocated to an individual, regardless of their tax rate, it's going to be taxed as 106. I'm going to assume an 18% tax rate, that we've got enough beneficiaries that we can allocate $106,000 to enough people to keep us in the 18% bracket. That's $19,000. So the after-tax cash is $386, and after paying your tax bill, you're left with $294. So although it's a big feed during the 10 years, it releases more at the end because the tax rate's lower. But the problem is, if you're surrounded by people on $190,000 at the time of selling, 18's not 18. 18% becomes 47. And if you plug that number in, apart from bringing the colour to your cheeks, you're left with 263. So just because I did it in a trust, if at the wrong situation, I'm left with 263, and back over in the company, I think it was 301. So that's a $30,000 question.
I just think, is it worth all the headaches setting up a trust?
Well, this situation doesn't make sense.
So I think, for investors, talk to your accountant first before you go down this path.
Yep.
Because I see it time and time again, these trust setups, and I'm like, why?
Well, and this is saying, and not many people set up companies, but here's a situation where you would have been $30,000 better off setting it up as a company, even though someone would say, no, don't do a company.
Very good. Anything else to add to that? Jeremy, Dom?
Well, I think back in the day, I can remember a lot of the experts when I was a novice advising that you buy using the trusts, and I set up a few myself. Have there been changes over, say, the last 20 years that have made trusts less effective now than what they were in the past?
A lot of where a lot of the rules are going with trusts is where you have an active business, where you've got someone that's actually driving the profit in there. They say you can't go and allocate profit that you've made to somebody else. That's where the ATO get interested in this sort of stuff. With a passive investment vehicle like this, there's no argument really. It's income. That's what trusts are built for. They're built for passive investments that you can then allocate around the family and pick the person on the lowest tax rate. That's actually what makes sense to them. They make a lot more sense when they're positive geared to negative geared. But you just got to be careful of the extra costs.
So for an individual investor, there would be no benefit. It's whether you've got family. It's when you have a variety of beneficiaries that you can pick and choose where it's most efficient to allocate those.
Yeah.
To distribute funds. Yeah.
Yeah.
Okay.
And back to Damo's earlier point was the bucket company. If you run out of people, so the earlier example where we had, if we look around and say everyone on me is on 200 grand, I'm going to pay 47% tax on this. That's where you might actually go, you know what, I'll park this in a bucket company and limit my tax to 30%. That's an option that you can do with a trust, and you can decide that at the time.
Yeah.
Yeah, good point. And look, disclaimer, talk to your tax accountant.
Yeah.
You are a tax accountant, Don. But I think the other thing for me that I hear with trust is asset protection. So let's say you run a company, you get sued for some reason or whatever it might be, your assets as a director, I think you mentioned earlier, can come into it if you've got properties in your personal name. So if you had it within a trust, are you more protected? Because that's where I see maybe doctors might put properties into trust, I would see potentially.
Yeah.
Like where are the sort of higher risk employments where you see trust set up for individuals?
Look, this day and age, the risk is everywhere. So you just pay a couple of basses late and the ATO sends you a director penalty notice, and then it's your personal assets on the line. So definitely either company or trust is putting a barrier between your personal life and the assets of that actual vehicle.
Okay. Great question. Looking forward to the next episode. Thanks for tuning in, everyone. And we'll see you in our next accounting episode. Bye for now and take care.